Welcome to the Deep Dive. Today we're tackling something that trips up so many investors in Europe, exchange-traded funds, or ETFs. It feels like there's this wall of jargon, right?
Yeah.
And rules that just don't match the global advice you see online. So we're diving into your sources, specifically looking at a really helpful 7-step checklist for navigating the European ETF scene. Our goal here is simple. Give you the shortcut. We want to distill these steps into the absolute key things you must know, things that can save you time, research headaches, and honestly, potentially costly mistakes that are pretty unique to European platforms.
Absolutely. And we have to start right there because so much standard advice like just buy the big US funds, well, it's often a non-starter for Europeans. It's fascinating. The very first step isn't even about picking the best fund in the world. It's about understanding a regulatory wall you hit immediately.
Okay, yeah, let's unpack that. The regulatory gatekeepers. You see these huge US ETFs mentioned everywhere. Why can't someone in, say, France or Germany just buy them?
It comes down to something called UCITS compliance. It's basically an EU framework designed to protect retail investors, US-domiciled ETFs. They generally don't provide the specific documents needed, the key investor information documents or KIDs, and they need to be in the local language in a standard format, all required under PREPS regulation. That's the Packaged Retail and Insurance-Based Investment Products rules.
Ah, okay, so it's a documentation thing.
Yeah.
The US funds just don't provide the right paperwork for a European regulator.
Pretty much. And because of that, your European broker is legally blocked from selling you those non-UCITS funds directly. So right away, boom, your entire search has to pivot. You must focus on Europe-based UCITS-compliant ETFs. It completely resets the strategy, doesn't it? It wipes out a ton of common advice you might find online.
Wow, okay, so step one is just acknowledging I have to play in the European sandbox. That UCITS label is non-negotiable. Now that we're focused only on European ETFs, let's look inside the fund. What are the big choices within that European universe? The checklist highlights a few key distinctions beyond just, say, tracking a global index. The first one sounds really fundamental. Accumulating versus distributing. What's that about?
It really is fundamental. This choice directly impacts how you receive returns and, maybe more importantly, your own investment discipline. So a distributing fund, it pays out dividends or interest. It collects straight into your cash account.
Okay, so you get cash hitting your account regularly.
Exactly. You get that income. But then the onus is on you to reinvest it, which might mean small transaction fees each time. And, you actually have to remember to do it. Requires discipline.
Right. I can see how that could slip. It's like getting a small allowance you have to consciously put back into savings versus it happening automatically.
That's a great analogy. An accumulating fund does the automatic part. It takes all those dividends and interest payments and reinvests them inside the fund itself. You never see the cash.
So the fund's value just grows a bit faster because of that internal compounding.
Precisely. The net asset value, the NAV, reflects that reinvestment. For long-term growth, especially for younger investors maybe, accumulating is often the default. It's hands-off compounding.
Makes sense. It takes a bit of the behavioral challenge out of it. Okay, that's one big structural choice. The next one mentioned is physical versus synthetic. Physical sounds straightforward. The fund owns the actual stocks or bonds, right?
Correct. Physical ETFs hold the underlying assets directly. If it's an S&P 500 tracker, it holds S&P 500 stocks. Very transparent.
So why would anyone choose synthetic? That sounds less direct. Maybe riskier.
Well, synthetic or swap-based ETFs work differently. They use a derivative, a total return swap, usually with a big investment bank. They don't necessarily hold all the stocks, they hold collateral, and the bank promises to deliver the index's return via this swap contract.
Okay, why do that? What's the upside?
The main potential benefits are cost and tracking. Synthetics can sometimes have lower operating costs. Managing swaps can be cheaper than physically buying and selling thousands of stocks across different markets, especially for complex or niche indices. This might lead to slightly better tracking of the index, meaning the ETF performance matches the index performance more closely.
But there has to be a catch, right? What's the risk? You mentioned a bank.
Exactly. The catch is counterparty risk. What happens if the bank on the other side of that swap agreement gets into financial trouble and can't pay?
So the ETF could lose value even if the underlying index is fine, just because the bank defaulted on the swap.
That's the theoretical risk. Now, UCI's rules are strict here. They mandate collateralization. The bank has to post collateral, usually high-quality assets, often worth even more than the swap value, to protect the ETF.
Okay, so there are protections, but the risk isn't zero.
It's not zero. It's considered very low for UCITS funds due to those collateral rules, but it exists. Physical funds simply don't have that specific risk, so it's a trade-off. Except a tiny sliver of counterparty risk for potentially lower fees and tighter tracking, or go physical for maximum transparency on that front. Many prefer physical for core holdings.
Got it. Risk versus reward, as always. Okay, so let's say we've made those choices. We want maybe an accumulating physical world index ETF. Now we face potentially dozens of options, even within that narrow scope. The checklist says, be ruthless. Focus on the cheapest and the largest. Let's break that down. Why largest?
Largest, usually measured by assets under management or AUM, is generally a proxy for liquidity. A big fund with lots of assets tends to trade more actively. High liquidity means it's easier to buy and sell shares without your trade significantly moving the price. It also means the bid-ask spread, the difference between buying and selling prices, is usually tighter, which saves you money on each transaction.
So bigger often means smoother and cheaper trading. What about cheapest? This seems critical.
Oh, absolutely critical. Cheapest refers to the total expense ratio, or TER. This is the annual fee charged by the fund, expressed as a percentage of your investment. It covers management, admin, operating costs, and it's deducted directly from the fund's performance year after year, whether the market goes up or down.
It's like a constant drag on your returns.
Yeah.
We talk about compounding growth, but this is compounding cost.
Precisely. A difference of, say, 0.1% or 0.2% in the TER might sound tiny, but over 20, 30, 40 years of investing, that small difference compounds into a huge chunk of your potential final wealth. It's incredibly impactful.
So filtering by lowest TE and largest AUM is a really efficient way to weed out potentially expensive or hard-to-trade options for your core portfolio.
Definitely. For major broad market indices, those two filters will get you very close to the best options very quickly.
Okay, clear. Now, the final hurdle mentioned in the sources, the listing labyrinth. This sounds confusing. You find the exact same fund, same index, same structure, same TER, but listed on multiple stock exchanges. London, Frankfurt, Amsterdam. Maybe in different currencies like euros, pounds, dollars. What's going on here?
Yes, this catches so many people out. The key mistake is assuming the currency the ETF is listed in somehow protects you from currency risk.
How so? If I live in Germany and buy an ETF listed in euros on the Frankfurt exchange, surely that's a euro investment.
Not necessarily, not in terms of the underlying risk. The listing currency just dictates what currency you use to buy and sell the shares on that specific exchange. But think about what the ETF actually holds if it's tracking, say, the S&P 500.
The underlying stocks are all American, priced in US dollars.
Exactly. So even if you buy that S&P 500 ETF using euros in Frankfurt, the value of the fund's assets is fluctuating based on the U.S. stock market and the euro versus U.S. dollar exchange rate.
I see. So your return isn't just based on whether U.S. stocks go up or down.
Correct. It's also based on whether the euro strengthens or weakens against the dollar. You have dual exposure, market risk, and currency risk.
Let's use an example. Say the S&P 500 index rises 10% in dollar terms, but during that same time, the euro strengthens 10% against the dollar. What happens to my euro-listed S&P 500 ETF?
In that simplified scenario, your return in euros could be close to zero. The market gain was effectively wiped out by the currency movement working against you.
Wow, that's huge. So how do you manage that?
You need to check if the ETF is explicitly currency hedged. Some ETFs use derivatives to try and neutralize that currency risk. They will clearly state this in the name, something like MSCI World EUR Hedged. If it doesn't say hedged in the name,
You have to assume you're taking on that currency risk based on whatever the underlying assets are denominated in.
that's the crucial takeaway. The listing currency is just for the transaction. The real currency exposure comes from the assets inside the fund, unless it's specifically hedged back to your home currency. You need to know what's under the hood.
That clears up a lot of confusion. Okay, so we've walked through the whole checklist, really. Started with the absolute must-do, UCITS compliance, filtered by Europe-based funds only. Then made those key structural choices. Accumulating for auto-compounding or distributing for income, physical for transparency or synthetic for potential cost-tracking benefits, accepting counterparty risk. Then filter practically, find the cheapest, lowest TER, and largest, most liquid versions available. And finally, understood the listing currency versus the underlying currency risk, deciding whether you need or want a hedged product.
Exactly. It's a series of deliberate choices tailored to the European environment. It's not as simple as maybe in the US where one or two big funds dominate discussion. You have to be more proactive here.
And the sources provide a tool to actually do all this filtering, right?
Yes, the mention of the Just ETF screener or similar tools is vital. These screeners let you input all these criteria: UCITS, accumulating, distributing, physical synthetic, TER limits, currency, hedging, and they instantly filter thousands of European listings down to the few that match. Trying to do that manually would be incredibly time-consuming. The tool makes implementing this checklist actually practical.
That's incredibly helpful. So a clear framework and a practical tool to execute it. This has been a fantastic deep dive, really clarifying the specific path for European ETF investors. Thanks for breaking it down.
My pleasure. It's complex, but manageable if you follow the steps. And maybe a final thought for you to consider, building on that accumulating versus distributing choice. If you do opt for a distributing fund, think about the psychology. How does that need to manually reinvest the dividends affect your behavior, especially during a scary market crash? Is the automatic nature of accumulating funds maybe also a form of, let's say, behavioral protection against panic or inaction? Something to chew on.
That's a great point. The intersection of structure and psychology, definitely something to think about. Until next time, stay curious,